going to be under here. So I'm going to highlight these. I'm going to pull this down. I'm going to pull this down, and let's see if it lets. Then I'm going to highlight this. I'm going to go to the paintbrush and put that up there, and then we're going to say, all right, so this equals the utilities, the fixed portion, which is the 232 minus the 72,000, which is the variable portion, and see if that fixes everything. And so now this is my new total, and now our check figure here ties out to this number here. So these numbers then look correct to me, and I like to, anytime I can get a check figure to make sure something didn't go wrong, and of course I did that totally on purpose just to demonstrate that, then I would do so. So now we have those numbers, and we can go forward with this. And so now we're going to say, if we had units of sale for 21,000, then we're going to say, okay, well, now we've got the 225 per unit times 21,000. There's our new sales, what we would think would happen, not if we had 15,000 units sold, but the 21, which is, of course, what actually happened. So what we're doing now is we're making a budget based on actual units produced. So that's going to be the idea. So now we're going to say, okay, we would think that we would have 60 times the 21 for direct materials. We would think that if we made 21 instead of what we thought 18, that we would have this number in terms of the direct material used. Direct labor, 15 times the 21. We would think that we would not be having direct labor of 270 if we made 21 instead of 18,000. We would think, based on that budget, that we would have 315. And so that's what we're going to use in order to measure how well we did in terms of allocating our labor. So we're going to do the same thing for the machinery. So this times the 21. We're going to do the same thing for the utilities, for the variable portion in this case. And we're going to do the same thing for the packaging. So the packaging there. And we're going to do the same thing for the shipping, like so. And the same thing for, well, we could do the same thing for the total variable cost, but I'm going to do it this way. I'm going to go to the Home tab, going to underline it, and then we're going to sum this up. So I'm going to say this equals the sum of the variable, not the sales. Don't include the sales in there. It's the direct materials down to the shipping, and enter. And then we're going to say this equals the sales minus the variable portion. That's the contribution margin. I'm going to go back up here in Home tab, font, underline, then go here, go Home tab, font, double underline, and I'm going to go here and do that here too. Home tab, font, double underline, and there's that. Now the fixed costs are real easy because we would expect those not to change. Those should be exactly the same fixed costs. We're just saying those should not change. That's like the rent that doesn't change. So I'm going to go to the paintbrush. I'm going to pull that over here. And then we could sum up the fixed costs, which just are the same. And so that's nice. And then we can see what actually happened. So now we're going to compare to what actually happened. So now we've got to pull over the actual numbers, which we have here, but it's in that other format. And we need to pull it into our FlexBudge format. So we're going to say, okay, this equals the 4,803,000. And we've got the direct materials is going to be this number. And then we've got the direct labor is this number. And then we've got the machinery is going to be this number. And then we got the utilities. And remember, the utilities were mixed. So I didn't actually give it, it's not saying in the data here, but we're going to break out the mixed and fixed portions. So I'm going to say that's given that the variable portion of the total of the 240,000 in this case is going to be 83,000. So that's going to be given, and that's part of the data set. Okay, and then we have the packaging. So packaging, we're going to say that's over here in this column. We're looking for packaging 123,750. Then we're looking for shipping. So shipping is going to be over here. Shipping 160,005. And then we can underline this Home tab, font, and underline like so. And then we could sum this up equals the sum of this 1,275,000 down to the 160,005. And then we can underline that. So we're going to go to the Home tab. We're going to underline that. And then we're going to say this equals the sales minus the variable cost, giving us the contribution margin. Home tab, font, double underline, and then we're going to have the fixed portion, So the depreciation is going to be this number here, depreciation right there. And so then we're going to have the utilities, and the utilities, we're going to say that the fixed portion is 157,000. Once again, that was that mixed cost that we're going to give you the breakout here between the total cost being the 240,000, 157,000 we're going to say is fixed for the purposes of the problem here. And then we're going to say the plant management, so plant management salaries is going to be this 240. And we're going to say that the sales salaries are down here, 279. We're going to say the advertising is going to be over here, 141. We're going to say the sales salaries administrative, 251. And we have finally the equipment, the 93.5, and I'm going to go ahead and underline that with the home tab font and underline that. And we could sum up the fixed costs then equals the sum of the fixed costs. So here are these, and that adds up to the 1,176,500. And then we should have done this on both sides. We want to get to the total here, which is the income. Well, I could do it this way. We could say this equals the income from operations. So we don't have it, of course, here, but we have it here. We're going to say that's going to be this number, the contribution margin, I should say, minus the fixed costs. We're going to do it here. We're going to do the same thing. We're going to say the contribution margin minus the fixed costs. And there we have that. So now this is what we would expect to happen. This is the bottom line. I can go ahead and underline these. Maybe I should do that too. I'm going to go home tab, font, underline, and then we're going to double underline these. Go into the home tab, font, and double underline. This is what we would expect to have as the bottom line in terms of net income if we were to have 21,000. That's the flexible budgeted number. This is what actually happened. And so now we can go line by line and have a better comparison of what we would expect to happen at that production level, 21,000, rather than comparing different production levels, which gives us kind of distorted data in some cases. Okay, so I'm going to do the difference here. So I'm going to do the same thing. I'm going to say this equals what actually happened. I'm going to take this number first minus what we budgeted to happen at that production level, at that flexible budget. Obviously, we got more money than we thought at that budgeted level. That's what we call a favorable difference. So I'm going to put an F here for favorable, and then down here, so that's not failing, that's favorable, just so we know that the F is favorable and unfavorable. Those are what those stand for. Okay, so then we're going to have down here, we're going to have the materials is going to be this number minus this number. So this is what we expected, and this is what we expected. This is what actually happened. So what actually happened is greater in terms of material. We spent more material based on the same level of production than we thought. Now we can go to the materials, say, that's not a favorable difference. Now we can go and measure the production department and say, hey, you know what, you spent more material. Are you wasting material? Did we have problems with material here because we spent more than we thought we were going to based on the actual level of production that was done, not based on a lower level of production. The labor here, we can say, okay, that's going to be this number minus this number. Again, we spent more on labor than we would expect to spend on that number. So now we can drill down on that and say, okay, what happened there? And then we got the machinery repair. It's going to be this number minus this number. And the repair person, we're happy with the repair function because that is favorable. We spent less than we expected to, so that's a good difference. And then we have the utilities, and we spent less, once again favorable for the expense side of things. Packaging is going to be this minus this, and once again favorable here. So then we got the shipping is going to be this, and obviously we could copy and paste this down, and that's going to be favorable. And then we're going to have the total variables are going to be this minus this, and that's the total is unfavorable. So notice that even though we have these favorable differences here, it looks like mainly the direct material and the labor are turning it the total unfavorable for in terms of the variable costs here. And then if we take this number and the contribution margin minus here, we're saying this is basically our contribution margin, kind of like gross profits, but it's the sales minus the variable costs. So we want that number to be higher. And in this case, this is what actually happened, and this is what we expected to happen, and it's higher, therefore it's favorable in this case. So you kind of got to think those through to see if you're going the right way and favorable, unfavorable. So now we'll do the same thing here. We got this minus this, no difference here. So this is like NA, we'll say not applicable for the unfavorable, favorable thing. And then we're going to say this minus this. So what actually happened is less, so that's favorable, that's good. Good thing happened. And then we're going to say this equals this minus this. We spent more, so that's unfavorable. And then we're going to say this minus this. And we spent more, that's unfavorable, on the sales salary. And then we're going to say this minus this, advertising. We spent more on the advertising. What is going on here? And then we're going to say this minus this, same, not applicable on the favorable, unfavorable because it's the same. Then we're going to say this minus this, and that's going to give, what happened there? That's not right. This minus this. And why do I have a negative number? Equals that minus that. Okay, that makes more sense. And that's unfavorable, a lot of unfavorables here. Okay, and then we're going to say this minus this in terms of total fixed. And so we have unfavorable of the 36 there. And then if we took the totals, we got this minus this. And again, this is net income, so we would like this to be higher. And it is higher. So our net income bottom line, we made more than we thought we were going to make based on that production level. So that's favorable. So notice this gives us a lot more information we can deal with now. We look at the bottom line, we said, we did better than we would have expected based on the sales volume. But we do have a lot of places to work. We can still go into these areas and say, what happened? Is it our estimate that's wrong, or what happened with these here? And on these favorable ones, again, even if it's favorable, if there's a big difference, we want to say, hey, do we need to fix our estimates? I mean, can we improve? And these, and why is that an L? That seems funny. This should be unfavorable. And these two unfavorables are things that we definitely could look into and say, okay, is that our estimate that's wrong? Or is that, can we do better there? And so there's always room for improvement.